Hi there, welcome to kneppyinvests. It is the middle of December, and this time of the month I do have a look at the state of the markets, and this is where I tell you if I am bullish, bearish, neutral on where the markets might be heading over the next few months, next few years. And I do believe that it's almost impossible to accurately determine where the stock market will be in the next few months. But we can be bullish or bearish, and it's all based off probability. And the way we do determine, or I determine whether I'm bearish or bullish, is just looking at the overall sentiment behind the current state of the markets. And human psychology is incredibly important to moving the markets up or down. The other thing I'll be doing in this video is looking at some interesting news items I have seen over the past month and talk about how they're relevant to the market or how they're not relevant, or maybe they're just interesting to me. First slide here is looking back at where the market was 1 month ago on November 19. The XJO was at 7,396.5, and we had been in a nice, really good sustained uptrend from November last year all the way to August this year. That's where we did reach a high of just above 7,600. But since that high in August of this year, we have been treading water. Did look fairly negative during the later period of September into the start of October. We have seen a little bit of a recovery, but the XJO has been going sideways. So when you just look at the daily up until November 19, you have to say, and I think I was fairly neutral at that point in time. Wouldn't surprise to see it go up from here or even go down. So where has the XJO gone in the past month? Well, let's have a look at the updated chart. And in the past month, the XJO actually has fallen to 7,304. I've slightly adjusted the moving averages in this, so it's now 20, 50, 100, and 200-day moving averages. And those stars are the buy the dips moments in the last 10 or 11 months. And we had seen 4 buy the dips moments where people saw the market had dropped and they thought this is a good time to buy. And the last buy the dip moment actually did fail. I've also drawn in a downtrend. Yeah, it does look like we are in potential downtrend right now, and that's that sloping blue line from the high we did see in August, and we actually have seen the XJO hit that downtrend twice in the past month and a half. The reason I've included the 200 and 100-day moving average is the last few times we have seen the market get towards the 200-day moving average, we did see a little bit of bounce. So right now, it does look like the 200-day moving average is a little bit of support. And if the market does fall below the 200-day moving average, that would be a fairly bearish signal. So right now, particularly because we are in a bit of a short-term downtrend, because we do have that 200-day moving average getting close to that downtrend, I think over the next few months, it's going to be highly important to whether we move into a downtrend or we move into a new uptrend. I have no idea what's going to happen because I'm not a soothsayer, and forecasting these types of things is almost impossible. So if you ever do hear someone try to tell you what the market is going to do over the next few months, more than likely they are going to be wrong. And I'll be talking about how you should completely ignore any sort of economic forecast you do hear later in this video. Now onto one of the American indexes, that's the S&P 500 daily. Unlike the XJO, which there is a bit of neutral, even bearishness in there, still some positive signs when you look at the S&P 500 and also the Nasdaq, even the Dow Jones. They're all still in well-defined uptrends. Every single time, 4 times in the past year and 3 months, where we did see the S&P 500 move just below or near the 100-day moving average, we did see it bounce, and that's just happened in the past month. It reached 400 or 4,500, and we saw a bit of a bounce. But the S&P 500 is having trouble getting above 4750. We have seen a bit of resistance at that level, And if we do see the S&P 500 get above 4750, that would be a bullish signal. Now, this does not include trading on December the 17th, and the S&P 500 fell by another 1%, but it's still in an uptrend. That does not give us or move S&P 500 in a downtrend. So a little bit different when you're looking at the American market, still in an uptrend, particularly when you look at the S&P 500 and the Nasdaq. Particularly, and I want to really reinforce this, most of the heavy lifting on the S&P 500, I think even the Nasdaq, is being done by just a few companies, and the top companies. So Microsoft, Apple, maybe not Tesla, but Microsoft, Apple, Nvidia, all those sort of companies are doing the heavy lifting, and they are the biggest or highest market cap companies. And when you look at sort of the mid-tier tech companies, you're seeing a lot of those companies are in well-defined downtrends. And I have heard commentary in regards to this being a worrying sign moving forward, because the last time this happened, or one of the only times this has happened, has just been before a crash. I want to do a little bit more research on that to confirm that, but just keep that in mind, that most of the heavy lifting on the American markets are being done by just a few of the biggest companies in the world. I just want to touch upon some of the weekly and monthly charts. So this is the weekly for the XJO going back to 2009, and we have been trading in this upward sloping channel since then. Every time we've been at the top of the channel, we do see a little bit of a sell-off. Every time at the bottom of the channel, we do see a little bit of buying, apart from the COVID-19 financial panic, when we just shot through the bottom of the channel fairly quickly, but then we recovered quite quickly. And just ignoring the COVID-19 financial panic, because that was extenuating circumstances. A few months ago, we did go above the top of the channel for a brief moment, then we saw a bit of selling, but we're still at the top of the channel right now. So don't be surprised if we do see a correction in the market. If we do see eventually the XJO move towards the bottom of the channel, that could be next week or starting next week, or could be 1 year from now, or maybe 3 or 4 years from now, because sometimes when we do get to the top of the channel, we remain there for a little bit of time. We saw that way back in 2009, but a lot of times when we do get to the top of the channel, we do see a correction soon thereafter. As we turn our attention to the S&P 500 weekly, I've excluded all the moving averages just to make it less cluttered, but this goes back to 2009, just like the XJO. And from 2009 to the COVID-19 financial panic, the S&P 500 weekly was in a well-defined uptrend, as represented by that sloping blue line. There were indications back in 2019, just after we had that little bit of a dip in the markets because there was a threat of rising interest rates, that the S&P 500 was accelerating in its move upwards, and that acceleration has really amplified ever since COVID-19 financial panic. And the distance between the S&P 500 right now and the uptrend is quite large. And whenever you see the distance between an uptrend and the price of something, that means there is a greater possibility of a correction in the future. Doesn't mean it would happen, but there is that greater possibility. I'll briefly touch upon the XJO Monthly. Over the past 40 years, since 1981, it actually has been, or the XJO has been, in this long-term uptrend, represented by that sloping blue line. And the XJO has touched that uptrend 5 times in the last 40 years, back in 1991, 92, 2003, 2009, and then during the COVID-19 financial panic. And every single time the XJO hits that upward sloping line, we do see it bounce off it. In fact, the COVID-19 financial panic didn't quite get there. In fact, my buy-in or go-in for the XJO was 4,000. It got to 4,400, and at that point in time, the uptrend was at about 4,200, 4,250. So I was being a little bit conservative about going all in at 4,000, but I thought we might actually, because of the fear in the market, the XJO actually might fall through that particular uptrend. I've also included the upward sloping channel, and we are near all-time highs just looking at this linear chart. I'll talk about why I use a linear chart, not a log chart, in the next slide. The one thing I really take away from this is twice in the past 40 years, we saw an acceleration in the XJO Monthly back between 1983 and 1987, and then again between 2003 and 2007. And both times we saw an acceleration in the XJO. We saw a major correction thereafter, and we don't quite have that right now with the XJO. There's been no acceleration in the market. So I'm not that concerned about a significant correction like we had back in 1987 and during the GFC. That previous chart I showed you was a linear chart. This is a log chart. I have been told by a few people I should be using log charts, not linear charts. And the main reason I don't use log charts for like a 40-year period. Now, I do use log charts if I'm looking at a 100, 120-year period, particularly like the Dow Jones. You need to look at a log chart. But one of the reasons I don't look at a log chart for the XJO Monthly, it just smooths out some of the things I want to be looking for, and I just prefer the linear chart because I get so much more information out of that particular sort of chart. You might be hearing some people talk about the tech bubble, and I'm not sure if this is to try to talk about how history doesn't repeat but it does rhyme. And if we go back and compare what happened with the Nasdaq just before the tech bubble burst and what's happening now, there are some similarities there. But again, history doesn't repeat but it does rhyme, and this doesn't mean we're going to see a major crash in the Nasdaq, but there are some similarities there, and those who are trying to poo-poo all these similarities don't quite get it because they're saying, well, there's real businesses now. Back then, there wasn't real businesses. But a lot of the tech stocks on the Nasdaq are not profitable. Yes, they have revenue, but they are being far from profitable. In fact, they may not be profitable for the next 5 to 10 years. And that is a worry because the way we value companies is to take the present value of all future cash flows. And if a company hasn't got any cash flows over the next 5 to 10 years, then how can you value that company accurately? And that's why we have seen a major sell-off, in my opinion, in the mid tier of Nasdaq companies. You'll see some major companies down 70% over the past 6 to 9 months. And I think that's one of the reasons why we are seeing that sell-off is because we're in a risk-off moment. And the only thing that's keeping the Nasdaq and the S&P 500 up are the Apples, Microsofts, the Googles, I should say Alphabets, those sort of companies that do have profits and have profits that are growing at really consistent rates. Now onto some news articles or some newsletters that have piqued my interest over the past month. And the first one here is an article, I think actually it's a newsletter, called When Bubble Meets Trouble from John P. Hussman. He's the president of Hussman Investment Trust. He wrote this on November 9. I only read this just a week ago. This guy is famous for predicting the tech bubble crash and the GFC. And he has a lot of data and research to back up his predictions. So he is saying right now that the expected returns in the equity markets over the next decade are going to be quite low compared to treasury bonds of all things. And this is a chart in his newsletter that backs it up. And it just shows you the correlation between Hussman equity risk premium model, looking at MAPE, which is the margin adjusted PE, and MCAP over GVA, which is the ratio of US non-financial equity market capitalization to corporate gross value added, including our estimates of foreign revenue, and the actual subsequent 12-year S&P 500 and return, total return in excess of treasury bonds. So there's a really good correlation between these two things. But you'll notice that the actual subsequent 12-year S&P 500 annual return only goes to 2009 because that is looking over the next 12 years. So if you go back to 2009, the actual annual return in excess of treasury bonds was around 12%. And that's what you would have got or received in returns over the next 12 years. And you can just see how the red and blue line correlate really well. And you'll notice the blue line has been dropping ever since 2009. And right now, it's at negative 8%. So what John P. Hussman is saying is the expected returns on the S&P 500 over the next 12 years is going to be negative 8% in excess of Treasury bonds. And what that is saying to us is you get more returns by investing in Treasury bonds than you would in the S&P 500 because of how overvalued the markets are right now. And to back that up, we have this S&P 500 mean reversion model suggesting S&P 500 is strongly overvalued right now. In fact, it's higher than what we saw during the tech bubble in 1999-2000, 89% above the trend line. So if you do believe in mean reversion, and there's no reason not to believe in mean reversion, then the markets right now, the S&P 500, the Nasdaq are overvalued at this particular point in time. Now you might be saying, well, the reason why they're so high is because of interest rates. But do you believe that interest rates are going to stay at 0.1% over the next decade? One of the other things I really look at is the CAPE or Shiller P ratio, which right now at this very moment is at 39.17. The only time it has been this high before in the past was back during the tech bubble, which got to almost 45. We can just see the PE ratio or Shiller P ratio keep on climbing. I've seen people trying to explain this away in terms of, well, the interest rates are really low and that's why the Shiller P ratio is really high right now. But again, do you really think the interest rates are going to stay at 0.1% for the next decade? It's a pretty, I'll say, dubious assumption to be making at any point in history to think that interest rates can stay at such a low point over a 1 or 10-year period. I saw heaps of articles towards the end of November in regards to how much restaurants were paying some of their staff. Dishwashers on $90 an hour as staff shortages smash hospitality sector. Rockpool Bar and Grill was paying dishwashers that amount on Friday and Saturday. I've also heard that some restaurants actually were closing down because they did not want to pay some of the staff that amount of money. That makes sense if they would be loss-making because of the wages they had to pay. But I think in some cases, they just didn't want to pay their staff that amount of money. And it's another reason why this hospitality sector, the leaders in this area are pleading with the government to increase the amount of international people coming into Australia so they can take these jobs, because historically it's international people who do this sort of work. You won't find a lot of locals who are willing to become a dishwasher because it's just not something we do. Another interesting article I read recently from CNN Business, written by Alison Morrow and Anakin Tapp, titled "How Millions of Jobless Americans Can Afford to Ditch Work." You don't get much sense about what this article is when you read the title, but there were a couple of very interesting paragraphs within this article that did make me think and gave me a different perspective on why there is such a shortage of staff, particularly in America. So it states here that nearly 70% of the 5 million people who left the labour force during the pandemic are older than 55, according to researchers from Goldman Sachs, and many of them are looking to return. So they've seen the opportunity to retire because of all the stimulus, and the assets they have just exploded in price, and they just don't have to go back to work. So that's one of the reasons they are saying there is a shortage of workers in the United States. In assessing the jobs recovery, economists have pointed out that while the unemployment rate has come down, the labour force participation rate hasn't improved at the same pace. But Jared Bernstein, a member of President Joe Biden's Council of Economic Advisors, said that once non-prime age workers, those over 55, are excluded from the metrics, a much clearer picture of how the labour recovery is doing emerges, because it strips out the retirement narrative. So it's very interesting, because I really didn't think of this as being a problem, that you've got all these people who have retired much earlier than they would have because of the pandemic, because of the stimulus, and that's why there is a shortage of staff, and that is why we're getting some wage pressure, wages starting to increase at a fairly good rate in the United States. and that could put pressure on prices. Prices then could rise, and then the cycle of inflation just goes on going around. And if people or workers expect inflation to become an issue, they're going to ask for more wage rises, and then we get into an inflation spiral. And that is the thing that really concerns a lot of people out there, apart from governments and a lot of central banks. The last article I want to show you in this video is from 1 year ago, December 7, 2020. Bloomberg News, Reed Pickett and Vince Golley wrote this article. And the reason I want to include this in this article in the video is to reinforce the point that you should never make personal decisions based off economic forecasts. It's really important because economic forecasts are really hard, and we should have seen, or you should have seen, proof of this over the past few years. So whenever you hear central banks or economists say, well, they expect interest rates to remain low, inflation to remain low, house prices to fall 20%, don't believe it. More than likely, they are going to be wrong, and hopefully this article from 1 year ago should reinforce this. So let's have a look at some of the points made in this article. The story of US inflation in 2021 could very well amount to this. It's all a mirage. Now, I can't remember back then, I can't remember if people were thinking that inflation was going to be a problem. But economists in the US said, no, it's not going to be a problem. All is sweet. It's going to be low. And the chief US economist at JP Morgan Chase, Michael Ferroli, stated, we think inflation is going to be mooted because unemployment will still be high. And then forecasters or economic forecasts surveyed by Bloomberg generally expect inflation to be temporarily rise above 2% in the second quarter of 2021 before settling back at or slightly below that level. How wrong were they? Right now, it's almost 7%, not 2%. So again, just because you do have these economic forecasts being made, don't make any decisions based off the forecasts. That's all I have for this video on the State of the Markets, December 17 edition. If you have any questions about anything I've mentioned in this video, please leave a comment, your thoughts, or a question in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.